Did you know that in 1980, during a period of rampant inflation in the United States, the price of gold skyrocketed by over 300% in just 1 year, reaching an all-time high of over $850 an ounce? Meanwhile, the average American's purchasing power was eroding at an alarming rate, losing nearly 14% of its value annually. This stark contrast wasn't just a coincidence, it was a desperate scramble for safety. Today, as we face new inflationary pressures that feel increasingly less transitory, a crucial question reemerges. In an era of potentially uncontrolled inflation, where do you put your money to protect and grow your wealth? Should it be the timeless allure of gold, the digital frontier of cryptocurrencies, or the tangible stability of real estate? This isn't just an academic debate, it's a vital decision that could define your financial future. For centuries, gold has been the undisputed champion of inflation hedges. It's tangible, beautiful, and its supply is inherently limited by geological constraints. When central banks print more money, devaluing fiat currencies, gold tends to hold its intrinsic value, acting as a historical store of wealth. Think of it as the ultimate financial bunker, a safe haven where investors flee when the economic storm clouds gather. Data from periods of high inflation consistently supports gold's role as a protector of purchasing power. For instance, during the 1970s, when inflation soared to double digits in the US, gold prices rose by an astounding 600% from 1970 to 1980. More recently, in the early 2000s, as the Federal Reserve expanded its balance sheet after the dot-com bust and the global financial crisis of 2008, gold saw significant appreciation. From 2000 to 2011, gold prices increased by over 500%, largely coinciding with periods of quantitative easing and rising inflation expectations. Its proponents argue that gold's universal acceptance, its lack of counterparty risk, and its deep-rooted cultural significance make it an unparalleled choice when traditional assets falter. You can hold it physically, invest in ETFs, or buy mining stocks, but at its core, gold offers a simple promise. It's nobody's liability, and its value isn't dictated by government policy or corporate earnings. However, the 21st century has introduced a fascinating new contender to the inflation hedge arena: cryptocurrencies, particularly Bitcoin. Born out of the 2008 financial crisis, Bitcoin was designed as a decentralized, scarce digital asset, often dubbed digital gold. Its fixed supply of 21 million coins is immutable, appealing directly to those who distrust central bank monetary policies and endless money printing. Proponents argue that Bitcoin's censorship resistance, global accessibility, and independence from any single government make it a superior hedge against inflation compared to traditional assets. We've seen periods where Bitcoin's price has surged dramatically alongside concerns about fiat currency devaluation. For example, during the aggressive monetary expansion of 2020 and 2021, when central banks worldwide injected trillions into their economies, Bitcoin experienced unprecedented growth, at times outperforming almost every other asset class. Its loyalists will point to its performance during these periods as proof of its effectiveness as a store of value. However, the volatility of cryptocurrencies is undeniable. A 20% swing in a single day is not uncommon, and major corrections can see prices plummet by 50% or more in a matter of weeks, as demonstrated in 2022. This extreme price fluctuation, while potentially offering massive upside, also presents substantial risk, leading many traditional investors to question its reliability as a stable store of value, especially when compared to gold's historically smoother ride. Then we have real estate, a timeless asset deeply ingrained in the human psyche as a foundational store of wealth. Land and property are tangible. They provide shelter, and they can generate income through rent. In inflationary environments, real estate often performs well for several reasons. Property values tend to rise with inflation as the cost of building new homes increases. Rental income can also be adjusted upwards, providing a growing stream of cash flow that keeps pace with rising living costs. Furthermore, if you hold a fixed-rate mortgage, inflation erodes the real value of your debt over time, making it easier to pay back with devalued money. Historically, real estate has offered a strong hedge against inflation, particularly residential and commercial properties in desirable locations. For instance, data from the National Association of Realtors shows that median existing home prices in the United States have consistently risen over decades, generally outpacing inflation. During the 1970s, home prices saw significant appreciation, offering a crucial buffer against the rapid devaluation of the dollar. In the recent inflationary period of 2020 to 2022, average home prices in the United States soared by over 30% in many areas, far exceeding the general inflation rate. However, real estate is illiquid, meaning it can be difficult to sell quickly, and it comes with significant transaction costs, property taxes, and maintenance expenses. Local market dynamics, interest rate changes, and even demographic shifts can heavily influence its performance, making it less universal in its application as a pure inflation hedge for everyone. Now here's a controversial take that challenges conventional wisdom. The very concept of a perfect inflation hedge is an illusion, especially in our current unprecedented economic landscape. Many financial pundits will tell you to diversify across these assets. But what if the inflation we are facing today isn't the same inflation of the 1970s? What if the digital age, global supply chains, and sovereign debt levels have fundamentally altered how inflation behaves and how assets react to it? Some argue that traditional inflation hedges like gold and real estate are too slow-moving or too dependent on physical constraints in a world increasingly dominated by digital flows and speculative capital. They might contend that Bitcoin, despite its volatility, represents a more nimble and truly independent store of value, capable of reacting to global monetary policy shifts almost instantaneously, precisely because it is digital and decentralized. On the flip side, a more radical perspective suggests that the very idea of escaping inflation is a distraction. They might argue that the only true hedge is an investment in productive assets, businesses that can raise prices, innovate, and adapt to rising costs. This means focusing on strong, well-managed companies, regardless of whether they produce a physical good or a digital service, because ultimately, their ability to generate profits is what will protect your capital. This viewpoint contends that simply holding gold or a digital token doesn't create new value, it merely shifts wealth around, whereas investing in innovation genuinely grows the economic pie. The truth is, each of these assets, gold, cryptocurrencies, and real estate, presents a unique set of advantages and disadvantages when confronted with uncontrolled inflation. Gold offers historical precedent and tangible safety, but its returns in non-inflationary times can be modest, and its price can be influenced by central bank gold sales or declining industrial demand. Cryptocurrencies, led by Bitcoin, offer a fascinating experiment in digital scarcity and decentralized value. They have the potential for explosive upside, but, they come with extreme volatility and regulatory uncertainty. This can, unfortunately, wipe out significant capital overnight. Real estate provides tangible assets, potential income streams, and benefits from debt erosion. However, it suffers from illiquidity, high entry barriers, and is susceptible to local market crashes or interest rate hikes. It's a bit of a double-edged sword, really. Ultimately, the choice of the best inflation hedge is not a universal one. It depends heavily on your personal risk tolerance, your investment horizon, and your understanding of each asset class. Are you a traditionalist seeking centuries of proven stability? Or maybe you're a disruptor embracing the cutting edge of finance, willing to brave extreme swings for potentially massive gains. Perhaps you're a pragmatist looking for a tangible asset with income potential, accepting its illiquidity. It's all about what suits you best. The reality is that in times of uncontrolled inflation, diversification across different asset classes might be your strongest defense. The debate isn't about choosing one single winner, but understanding how each of these powerful assets can play a role in safeguarding your financial future. So what do you think? As the global economy grapples with unprecedented levels of debt and monetary expansion, where do you see the safest haven for your wealth? Is it the ancient gleam of gold, the revolutionary promise of crypto, or the solid ground of real estate? Or perhaps a blend of all three, or something entirely different? Let us know in the comments below. Your insights and experiences are invaluable as we collectively navigate these uncertain economic waters.